Good morning. You're watching Bazaar Morning Call. We're in conversation now with Siddhartha Khemka, Head of Research at BND at Motilal Oswal Financial Services. Siddhartha, thank you very much for joining in. Wanted to get your thoughts in on what Dabur had to say. Dabur is talking about a revenue decline in its quarterly update for the first time in 4 years. And the street is clearly worried that it may not be limited to just Dabur. So in your channel checks going into the Q2 earnings season, what have you picked up in terms of consumer demand?
Yeah, hi, good morning. So I think, yes, it's definitely a cause of concern, especially if you look at on the urban side, what is happening. So consumer staples demand, our channel check suggests that demand has been relatively stable in Q2 on a Q-on-Q basis, with the rural markets outperforming the urban areas for the third consecutive quarter. However, we have seen that some of the issues, for example, heavy rains and floods in certain regions have disrupted the supply chain and also affected the out-of-home consumption and hence the overall consumer offtake. In terms of, if you look at the raw material prices, that has kind of remained a little bit on the softer side, and hence there is expectation of some gross margin expansion in Q2. And hence, some of the other segments, apart from, say, in the overall consumer staples, we believe things could see a little better. And hence, while Dabur has definitely kind of given an outlook of a weak quarter for the year, we believe some of the other names, for example, HUL, Britannia, Marico, their numbers could be slightly better than Dabur. And especially if you look at on the non-agri commodities such as crudes and its derivatives, that have kind of remained soft, and that should benefit companies in this space like soap, detergents, paints, adhesives. So it's a kind of a mixed bag in all, if you would like to say. And within that space, what we like is like a kind of a Britannia, Colgate, Marico. These are companies which could come out with good numbers. HUL, with a wide product basket and presence across segments, should help the company achieve a steady growth. GCPL is our top pick in the space. Its focus on the non-agro commodities, for example. It's a large player in the soap segment where we believe margins would kind of improve and demand from the rural to pick up. So that's a kind of outlook that we are looking at in the overall consumer space.
Okay, so yeah, consumer, I mean, it triggered quite a bit of a debate, right, with the update that we got from Dabur. But just to press on that point, Siddhartha, hi, morning and happy Friday to you. We've got the update from Avenue Supermart, and depends on how you want to slice and dice it, because Mangalam was telling us that maybe the market won't take that too well as well, looking at same-store sales, etc. So I don't know, if you got a chance to look at the numbers, what do you think?
Yeah, I think, yes, morning, Surabhi. So revenue growth definitely moderated. It is at to 14%, which is a 4% miss to our expectations. Revenue growth moderation, we believe, is largely due to the lower store addition in the past few quarters and the weak store productivity. We believe that the preference for convenience, that is your rapid adoption of quick commerce over value, would have contributed to the growth moderation for DMart, where DMart is clearly absent and is looking to increase its presence through the delivery channels, which is now we are seeing where a lot of growth is happening. So definitely some weakness in the numbers which the market may not like. But the overall, if you see the growth trend, that is pretty steady. So today the reaction could be negative. Productivity has also kind of been weak. For example, revenue per store at 1.5 billion rupees is up only 1% on a Y-on-Y basis compared to 4 to 7% growth that we have seen in the last 5 to 6 quarters. So to overall, the store addition also remains soft. For Q2, the number of stores added was about 6 stores, taking the total store count to 377. For the full year, we have an assumption of about 40 store addition. So definitely in Q2, the run rate in store addition was much lower than our expectations.
And what about Bajaj Finance? How would you read the Q2 update? AUM growth at 29% is slightly lower than the growth that we've seen in the last couple of quarters. And it's also uncertain on what the credit quality is going to look like, the credit costs. So thoughts on Bajaj Finance?
Yeah, Rima, I think Bajaj comparatively managed to give a better numbers. Yes, slightly lower than what we would have expected, but at an AUM growth of 29%, and nonetheless, in this environment is pretty good. So we believe that this growth might kind of enthusiast the market. A new client addition was healthy. This was the first normal quarter for the company with both the e-com and the Insta EMI card products available for the company compared to the previous 3 quarters where the RBI ban was there. New loans booked grew about 14%, and as I said, AUM growth was broadly in line with the expectation with up 29%. Yes, some concerns, especially if you look at on the credit side, where the retail credit costs have gone up in the recent past, and that could be something that we'll get to know only after the quarterly results. But I think overall, we believe that the numbers are quite good in this environment. We had seen softer quarters in the previous few, softer numbers in the previous few quarters, and with a 29% AUM growth, things looks much better for Bajaj Finance from here on.
All right, well, that is the view coming in on Bajaj Finance and financial.
Siddhartha, Harish was talking about sectors when he can't talk individual companies and stocks. Will you tell us stocks? One or two good names to pick as the dust settles on China, Middle East, crude oil, all of that. But fundamental picks right now in this market.
Yeah, so if you look at some of the sectors that we believe could do well, IT is one of them where the green shoots are seeing visible with the growth coming back with the Fed rate cut starting and consumption discretionary spending on the rise. So we believe that Q2 revenue growth for IT sectors could be decent. Client spending behavior is showing positive trends indicating potential return of modernization, especially in the discretionary spending in some of the pockets. And among the tier 1 players, we believe HCL Tech can be a better pick given its strong capabilities in data engineering, ERD offerings, the ERP modernization, as well as making it well suited for the pre-Gen AI spending. So we expect HCL Tech to see a broad-based growth across verticals as well as geographies. There could be some pockets like BFSI where the growth could remain soft. But overall, we expect a good growth. Margins are likely to see a 30 basis points Q-on-Q improvement. And we expect the company to maintain its growth guidance about 3 to 5%. So we like HCL Tech between the tier 1 IT companies. We have a buy rating and a target price of 2,200. So that's a space clearly that looks kind of pretty good in the current environment.
We've discussed, of course, Bajaj Finance, but a whole host of other NBFC and bank updates have come through, right? What is the sense you get in terms of this whole fight for deposits, what NIMs may move, how NIMs may move? And for some of the smaller lenders, like I was looking at Suryodaya Small Finance Bank. I mean, there the pain and pressure on the microfinance side is really showing up. So what are your top picks and what would you avoid this season in BFSI?
Yeah, Surbi. So I think overall, if you look at from the financials perspective, earnings growth are likely to be modest. While the asset quality trend could be divergent. What we are expecting is the system credit growth at about 12.5%, while deposit growth could be better at about 12%. And what we have seen that the deposit growth could be in this range of 11 to 13%. And that has been the range in the past 14 months. So what is happening is that asset quality for the large private banks as well as for the PSUs, that remains stable. However, for the MFA, the microfinance as well as the unsecured loans, they are experiencing rising stress. And some of these small finance bank, as you highlighted, they are more on the MFIs and the high risk segments, which are experiencing more increasing asset quality stress and leading to higher credit costs. Within the private banks, what we are seeing is a steady growth. We are expecting pre-provisioning operating profit growth of about 12%, NII growth of about 11%. As I said, for the private bank, slippages would largely remain under control. Similar is the story with a lot of these public sector banks, where we are expecting a steady quarter. But small finance bank, there could be mixed performance. Some of the microfinance facing companies are experiencing higher elevated credit costs and slippages. So overall, our top picks within the space, in the private banking space, ICICI, which has been a consistent performer, aided by strong growth and profitability in the past. We have seen that slippages has been under control, and the bank has outpaced the system credit growth, driven by good growth in the retail, SME, as well as some of the other segments. And overall, the return ratios are pretty strong. ROAs of 2.2%, ROEs of 17%, and valuations, although a bit on the higher side, we believe that with the strong performance and leadership in the current market, it could continue to trade at the premium valuation. So clearly, ICICI Bank is something that we like within the banking space.
Got it. Okay, so that remains one of your preferred picks. Good talking to you this morning, Siddhartha. Thanks for joining in. Have a good day, and we'll look forward to connecting again. Okay.